3 days. That's all it would take. 3 days of silence in one narrow strip of water, and the global economy starts to choke. No explosions on Wall Street. No dramatic collapse on your screen. Just something quieter, slower, more dangerous. Oil stops moving. And when oil stops moving, everything else follows. Because almost 20% of the world's oil supply flows through one place, the Strait of Hormuz, a thin corridor between Iran and Oman. At its narrowest point, just 33 kilometers wide. 2 shipping lanes in, 2 out. That's it. No backup route, no alternative highway. Just a global dependency hiding in plain sight. Now, imagine it closes. Not permanently. Just long enough to matter. Tankers stuck. Insurance companies panic. Shipping rates explode overnight. And suddenly, a problem happening thousands of miles away becomes your problem. At the petrol station, at the grocery store, in your monthly bills. But to understand why this single choke point has so much power, we need to look at how the system actually works. Because the system is fragile in a very specific way. Oil isn't just a commodity. It's a timing machine. Every day, about 100 million barrels of oil are produced globally, and most of it is already spoken for before it even leaves the ground. Contracts, futures, supply chains, refineries expect shipments on exact dates. Airlines hedge fuel months in advance. Entire industries run on schedules so tight, a delay of days creates chaos. Now place the Strait of Hormuz in the middle of that system. Roughly 17 to 20 million barrels per day pass through it, mostly from countries like Saudi Arabia, Iraq, UAE, and Kuwait. If that flow stops, even briefly, the world doesn't just wait it out. It scrambles because there's no quick replacement. Pipelines can't absorb that volume. Strategic reserves exist, yes, but they're limited and politically sensitive. And here's the uncomfortable math. Even a 10% disruption in global oil supply can push prices up 50% or more. We've seen smaller shocks do worse. In 1973, during the oil embargo, prices quadrupled. Economies stalled. Inflation surged. Recessions followed. Now, imagine a modern version, except this time, the world is more interconnected, more leveraged, more dependent, and less prepared. So what happens first? Oil prices spike, fast. Not gradually, not logically, emotionally. Markets don't wait for confirmation. They react to fear. Traders bid up prices. Insurance costs for tankers skyrocket. Some ships refuse to enter the region at all. Within days, crude oil could jump from, say, $80 to $150 per barrel. Maybe higher. And that's just the beginning. Because oil doesn't stay in the oil market. It leaks into everything. Transportation costs rise, airlines increase ticket prices, shipping companies pass costs onto retailers. Food prices go up, not because food is scarce, but because moving it becomes expensive. Electricity costs increase in countries dependent on oil-based generation. Inflation, which central banks have been trying to control for years, suddenly surges again. And here's where it gets uncomfortable. Central banks can't fix this. They can raise interest rates, they can slow demand, but they can't reopen a blocked strait. So now, policymakers face a dilemma. Do nothing and let inflation run? Or tighten the economy further and risk pushing it into recession? Either way, growth slows. Jobs are affected. Investments freeze. markets become volatile. And all of this traces back to a single point on the map. But there's another layer people don't talk about: the financial system itself. Oil isn't just physical, it's financial. Trillions of dollars in derivatives, futures, and hedging contracts are tied to stable oil flows. When disruption hits, these contracts start to break. Margins get called, positions get liquidated, and suddenly what started as a supply issue becomes a financial stress event. Banks get exposed, funds take losses, liquidity tightens. And if that stress spreads far enough, it starts to resemble the early stages of a financial crisis. Not because something collapsed, but because uncertainty spreads faster than facts. Now here's the irony. Everyone knows this risk exists. Governments monitor it constantly. Navies patrol the region. Strategic reserves are built for this exact scenario. And yet, the system remains dependent. Why? Because it's efficient. Shipping oil through the Strait of Hormuz is the cheapest, fastest option. Alternatives exist, but they're expensive, limited, or politically complicated. So the world keeps using the same route, hoping it never fails. It's a calculated risk. Until it isn't. Now, zoom out. If the strait stays closed for weeks, not days, the consequences compound. Emerging markets get hit first. Countries that rely heavily on imported energy see their currencies weaken. Debt becomes harder to manage. Then developed economies follow. Consumer spending drops. Corporate profits shrink. Stock markets correct, possibly sharply. And global trade slows, not because demand disappears, but because the cost of moving goods becomes unpredictable. This is how a regional disruption turns into a global slowdown. Not overnight, but steadily, relentlessly. And here's the part that's easy to underestimate. Even if the strait reopens, the damage doesn't instantly reverse. Prices take time to stabilize. Supply chains take time to normalize. Confidence, once shaken, takes even longer to rebuild. So the real impact isn't just the shutdown. It's the ripple effects that follow. Weeks, months, sometimes years, all from a narrow passage of water most people will never see. So the question isn't whether the world understands the risk. It does. The real question is this: if a single choke point can threaten the entire global economy, so the question isn't whether the world understands the risk. Why hasn't the system changed? Or worse, what happens the day it's not just a threat, but a reality?